Hello and welcome to the Monday Futures Market Outlook for October 15th, 2012. This is Patrick Sresna. For those of you that have not had the opportunity to try out eMoneySource.com's trading room, 5-day complimentary memberships are available on the website. As always, we start with a chart of the U.S. dollar index futures. We've obviously seen a bottom back in September, and the dollar has been trying to rally since. While we do feel that there's a very good chance that we've seen meaningful lows in the dollar for this swing, it doesn't mean that those lows won't be retested. If you recall, even back in the February, March, and April periods earlier on this chart, that once a key level was established, it was tested numerous times, and we feel that there's a genuine chance that that will still develop here. And so while we're not anticipating any substantial weakness in the US dollar, there will probably be opportunities to accumulate the dollar on weakness, as there likely is going to be a slight rollover here. Next year, when we take a look at the euro futures, you can see where some of that strength may come. If the euro can roll off of this little flagging formation that is shaped up, then we could see the euro not only head for a retest of its highs at this 130-150 focal point, but there's certainly a number of highs in the 133 to 135 level on the upside that could all be targeted if there was a bullish breakout. We won't be banking on that breakout yet until we see some follow through, at least back up toward the 130-150 level, but certainly some short-term weakness in the US dollar may come from a potential spurt higher in the euro. In the bigger picture, while there is room for the euro to come back and retest its highs and even attempt to break to a higher high, we are very skeptical of the sustainability of the euro at these higher prices. And so just because there's going to be a price move back up to those highs doesn't mean that makes it a good investment idea by any means. And in fact, in the bigger picture, fading euro strength is probably not a bad strategy. Next year, I want to take a look at the 30-year Treasury bonds, which have continued to hold up near their consolidation highs over the last 3-4 weeks. There is room for Treasury bonds to try to strengthen here. Obviously, there continues to be substantial amounts of intervention but on the Federal Reserve level to maintain low interest rates, which certainly spurs this to be bought every time there's a dip. But ultimately, there is room right now for these Treasury bonds to rally even back to 152 to 154 on the upside. In the bigger picture, the 30-year can slow a little bit in comparison to the 10-year, as we're continuing to see commodities holding up, which could be putting inflationary pressure into keeping the 30-year Treasury bond at a benign level. Overall, there is room for short-term strength, but we think that the 10-year will outperform the 30-year from a price perspective. Next year, when we take a look at copper futures, copper has continued to consolidate over the last month after having a very robust bullish push higher on the Fed news. Really, at this stage, this continues to look like a consolidation. Like we were suggesting all along in the last several weeks, is that so long as any selling is contained to the 355 level, give or take, then it's most likely going to be a buy on dip opportunity on copper. So let's watch to see where these consolidations continue to be contained and whether that allows copper to make a break higher. Next year, when we take a look at crude oil also has actually continued to behave relatively well. The 89 focal point down below was sort of our zone where we said all retracements need to be contained to, and so far the bulls have done a very good job holding that. And the way I would summarize oils, that's so long as it's above the 89 focal point, then we will look at it for a bullish break. And if it does get a bullish break, it would be very natural for it to return back to $100 high where it was trading just a month ago. So basically remain bullish above this 89 level. Any weakness below 89 will take that off the table, and we have to look at a number of alternative bearish scenarios, but we'll cross that bridge if it does break down. Next year, we're going to take a look at gold futures. Gold has struggled along the 1800, 1790 level to make any progress, and subsequently the last week has brought distribution in gold. While we've been looking at gold bullishly, but we've been suggesting that it's a buy on dip opportunity where we needed pullbacks in gold to be buyers. Now that we're getting pullbacks down towards 740, we could really see some very short-term weakness that could result in a short-term buying opportunity that could even approach 1700 on the downside. Overall, we do still anticipate further weakness, but we will be looking whether or not that will emerge as a buying opportunity. Next year, we're going to take a look at the S&P 500. We obviously have overhead resistance at the 1465 level, which marks something that looks like a double top. We had the S&P 500 selling for the last week, which is finding some initial support along this 1415 focal point, which marks sort of all the highs back in March and April, as well as the consolidation that occurred in August before the breakout. If this is not going to result in some sort of accelerated sell cycle, then this support may hold and allow the market not only to trade back up toward the top end of the range, but may even temporarily break to a higher high before coming back down. What we basically can summarize in the way we look at things is that the 1465 level on the upside is the top end of the range, and subsequently we could have numerous tests still into the top end of the range. We don't necessarily see much upside on the S&P, but it doesn't mean that the S&P won't test it a couple more times. We would need to see some material weakness below the 1400 level for us to really be bigger picture concerned about the markets. Overall, the market is overdue for a proper market correction. So after consolidation point, we'll be looking for where the dips will occur for potential buying opportunities. To summarize our key intermarket observations, while we were suggesting the U.S. dollar can go back to retest its lows, accumulating that U.S. dollar into weaknesses represents a reasonably good risk-reward proposition, as there are some important support lines below that are likely to hold, particularly as there's only limited upside to the euro before that will be distributed. In commodities, we also want to suggest that the risk reward is average, but carefully there could be an increasingly reasonable risk reward proposition, as we are seeing many of these commodities come off their highs, and as they do, then we may be changing that short-term risk reward to a good proposition. U.S. bonds, we leave it at average because there are numerous overhead resistance levels that the U.S. bonds have to exceed in order for things to be just accelerating bullishly on the upside. So while we felt that the risk reward was pretty good back down at the lows several weeks ago, right now as we approach these overhead resistance levels, it's just a modest average risk reward proposition. As for stocks and global stocks in general, we remain with a poor proposition. This poor proposition is not a reflection of the fact that the market can't on the short term go higher, but rather that the potential profits made on pushes higher is modest in compared to the risk that we undertake in being invested in them. So while we certainly can see short-term strength on the U.S. markets, we still rate it as a poor proposition. That was your Monday Futures Market Outlook. Thank you for joining me.